Hello, this is a part one video for the Accounting Cycle Excel project. And this video is, so we are in part one. We are going to do just the normal journal entries, which is step one. And these series of videos they're not here really to explain all the ins and outs. They're really here to mechanically show you how to do this in Excel. So you can pause the videos, go back, look at them slowly, step by step, but I am going to do the entire project as if I were a student. So here are your instructions on the instruction sheet. And this chart of accounts is just a reference to tell you all the accounts that are involved in the problem. And I'm just going to jump right into it and start with the normal entries. So the setup here is you have a bunch of normal journal entries which occur during the year, and then we'll have year-end adjusting entries, but we're not going to do those till we take care of some other business. So the first thing we have to do is just take care of the normal journal entries. And what you do is you read the memo and back into the journal entry. So here is, this company is just coming into existence and they issue stock for $300,000. So they capitalize the company. So when they issue stock, the whole point is to get cash. And we're going to put in two spaces because all your credit entries are indented a little bit. So I just put two spaces in here. So we're not going to do anything too fancy. We'll just have a common stock account, and it tells you 300,000. Now you could type 300,000 again, but what I want you to do is start using Excel functions and formulas. So there you go. So we're chugging along. We put in the amount, we put in the credit that it equaled the debit. So here we have one debit and one credit. So obviously debits equal credits. Now they purchase apartment building. They put $200,000 cash down, and the remainder is a mortgage loan. The land is valued at $100,000. So let's go look at the chart real quick. We have cash account, we have a building account, we have a land account. And what about liabilities? We won't call it mortgage loan. We'll use this account called a loan payable. Okay, so let's see, the cash. So the cash is going out. So what I usually like to start with cash because I can tell if it's going out or coming in. It's an asset, so we're going to decrease it with a credit. Okay, so cash is credited because we're paying something instead of receiving cash. The remainder, apartment building, 200,000 cash, the remainder loan, the land is valued 100,000. Oh, I guess I have to say the apartment building, a $1 million apartment building that was in there at one point. I don't know how we lost it, but we did. So let's see, we're going to increase liabilities with a credit. So our other liability is 800,000. And then the land is worth 100,000. So the building, you can see that it's worth 900,000, but what I'm going to do is let's use a formula. So it equals 200,000 plus 800,000 minus the land. So now you know debits equal credits. 1 million in debits and 1 million in credits. Okay, perfect. The next entry is we paid $8,000 for 10 months of property and liability insurance in advance. Okay, so we paid, so let's start with the cash. Credits always go last, debits first. Indent two spaces, 8,000 bucks. Okay, so we know that this equals 8,000 bucks. And if we go to the chart, we're looking for prepaid insurance. So we paid for insurance, but we haven't used it up yet because, like, if you pay for 6 months car insurance, you're covered for 6 months. If you cancel it, you get some money back. So this is prepaid insurance. Okay, insurance, all right. Received $150,000 for tenants for 1 year. Lease is paid in advance. This is a magical rental property, but just to make life simple, we receive cash. Receiving cash good. Okay. Now, as of today, we haven't provided anybody a place to live. So what we call this is it's a liability, unearned rent revenue, which you can find in the chart of accounts. 1215 received invoice from major maintenance company. Whoops. Invoice from major maintenance company for $5,000 net 30-day term. So net 30 days means we have to pay it in 30 days. So we don't have to pay it till January, but we owe it. And this is going to be maintenance expense. So this is an accrual. We're recognizing the expense. Let's see. So 5,000, recognizing the expense, and we owe somebody something, so it's a payable. Let's see what we have over here. I can't remember. Vendor payable. Okay, and I'll just put vendor payable for short. It would be a specific account. Vendor payable. And then we declare a dividend of 10,000. So that account is dividends. Period. Not dividends expense, just dividends. Dividends are never an expense. And they're payable on January 15th. So we owe something but haven't paid it. In particular, dividends. So, and equals 10,000. Okay, so now you've done all of these, and what you have to do is post them. And there are 3 ledgers just to make it a little more easier to follow. 80701. I think this should be 801. 080101. Okay, that's good. We received cash. So what we're going to do, we're not going to type it. We're going to use Excel, and we go down, look for cash. Okay, there's a cash debit. Well, bam, just post it. Posted it. Now, I've done this before, so I remember. But what you would do is go cash, cash, cash. Oh, here's cash, credit. Post it. I think I can't remember, so I do have to cheat. Can't remember if we paid the insurance first. Yeah, we paid the insurance first. So, up, cash. And then we received rent in advance. Good for us. Okay, and I have the totaling thing in here for you. We don't adjust cash. Adjustments are to revenues, expenses, assets, and liabilities. So there's no adjustments here. So you'll see our unadjusted balance and our adjusted balance are going to be the same, okay? So now let's enter the other account, normal adjusting entries. Prepaid insurance is an asset on, so let's go. We'll just kind of take these in order that they appear in the ledger. Prepaid insurance, bam, there you go. So we have the total adjusted balance here, but it's not done yet because we haven't put the adjusting, it's just totaling it up. Building is an asset, normal debit balance. We acquired, was that building or land? I already lost yeah, it was building. All right, building 900,000. Looking good. Accumulated depreciation, that's going to be a adjusting entry. And so for the assets, I think that's it. So let's go to liabilities. We don't have any income tax payable. We do have, let's see, maintenance payable. Interest payable, we have an accrued unearned rent revenue, a liability, normal credit balance, right here, 150. Loan payable, we incurred a loan credit balance. Up. And I guess I'll call that, actually I wasn't totally kosher here, loan payable, just to follow all the titling and the ledger. And dividend payable, we do have one of those. So we go back here, dividend payable right here, 10,000, click and enter, and there we go. And finally, what do we have? Common stock. Want to equal, we issued the first thing, 300,000. This is a normal credit balance. Retained earnings, we got nothing. We haven't had a year of income yet. Dividends. Where are you? Dividends right here, 10,000. Okay, so that's posted. We haven't had insurance expense. We haven't had rent revenue yet. Just unearned rent revenue is a revenue account. Unearned rent revenue is liability. We haven't adjusted depreciation. We haven't adjusted for interest expense, income tax expense. There is some maintenance expense though. So we did that upon receiving the invoice. So where are you? Maintenance expense right here. Okay, and I believe that does it. So at this point, I'm going to stop this video as part 1, and then the next one will be part 2, and then we'll do the adjusting journal entries. See you in part 2.